Hi everyone, I'm Sumera Abdi, and today we're bringing to you a new fund which can help you create a flow of regular income in the most tax efficient manner. Presenting the SBI Dividend Yield Fund. The NFO opens on the 20th of February and closes on the 6th of March. So what is this fund all about? Well, first things first. Dividend is a part of a company's profits which it pays out to its shareholders. Not all companies pay dividends, but quite a few do. Some pay larger dividends than others, and it's been a practice of many investors to accumulate the shares of such dividend-paying companies to generate an income for themselves. So to do this, they look at the dividend yield of a company. Now, dividend yield is pretty easy to calculate. So it's the annual dividend which is paid per share divided by the share price itself. For example, if the total dividend paid by a company during a year is 30 rupees and its share price is 600 rupees, then we can say that the dividend yield is 5%. So higher the dividend yield, more attractive that stock is for such investors. But what if the same was available to you through a professionally managed fund and in a more tax efficient manner? That's where the SBI Dividend Yield Fund comes in. I have with me Mr. D.P. Singh, Deputy MD and Chief Business Officer at SBI Mutual Fund, R. Srinivasan, who's the CIO Equity, and Rohit Shimpi, the Fund Manager of the SBI Dividend Yield Fund, to talk about this fund, its usefulness for an investor, and how best to optimize your income and taxation. So Rohit, you're the fund manager. Let me begin with you. Can you start off by telling us what is the concept of a dividend yield fund globally and also in the Indian context?
Yeah, sure. Thanks, Subra. So we did a lot of work on what is a dividend yield fund exactly. And in the global context, it was interesting to see that they are actually called equity income funds. And this is a popular category globally. We found several cases of funds which are multiple billions, tens of $billion in size. And generally, they are pitched to slightly conservative investors who still want capital appreciation from equities while providing some risk measures like lower volatility or lower some amount of downside protection on equities.
Okay, so DP sir, this concept has been there for a long time. So why have you chosen to debut this fund now? What is, the significance of this timing?
And at this point, I see the dividend-paying companies and dividend yield companies, so-called, are much lesser volatile than the other stocks in the market. That is one. And second, what has happened around 2 years back, all the dividends in the hands of investors have become taxable now. So there is going to be TDS, and whatever is there, you have to pay tax at the marginal rate, which was not the case earlier. Earlier, all the dividends were tax-free in the hands of investors. So that makes a good sense, because if the dividends are received through mutual fund route, it becomes very tax efficient, because we mutual funds being by statute the tax free entities, there is no TDS or there is no tax on us. So the net through mutual fund in the hands of investors is more, and that is number one. And number two, we want to put it as a solution for the investors. See, generally what happens, the investors are keeping some good dividend yielding stocks in their hands, and they are getting 5, 10, 12, 15 dividends every year. And to keep a track or all the TDSs, then putting them, it's a very, very cumbersome job. For the ease of investor, if the same thing is being done through mutual fund, they will get one cash flow. And the cash flow, we are not going to suggest to have only the dividend yield, but little more than that, you should have something from the capital gains also. So it will become, as Rohit was saying, the equity income funds. So income to be generated from the equities on the yearly basis to have a disciplined cash flow. So that's the idea, to give a very, very tax efficient solution to the investor and ease of holding the equity stocks for getting the dividends, and in a very, very tax free manner, tax efficient manner, to say so. So that is the idea.
Okay, so we'll explore this a little bit more in a bit. But before that, Vasan, I want to ask you that, these high dividend yielding companies are quite well known, right? A lot of people invest in them. So what is the value that a fund manager can bring to this concept?
Well, what we do, anybody can do. technically, but I guess the point being that dividend yield is just one variable. If you just focus on dividend yield and you decide to buy a stock, you are effectively missing out a lot of the other stuff that you need to look for in a stock. For example, sectors which are highly prone to disruption or which are already getting disrupted, print media for example, they could be high dividend yielding stocks, but they are also value traps. So you don't want to be buying those stocks. So I think a high dividend yield stock effectively also possibly is a reflection of it being a low PE stock in a way, not a low PE stock, but not a high PE stock kind of. But that itself is not good enough. You got to, a PE for example is a function of growth, it's a function of return on capital employed, it's a function of cost of equity, which is again, it's a function of what kind of business you buy. So it's a lot more complicated than just saying that this is the variable and that is the criteria. This is the key variable and there will be other variables that Rohit will obviously look at to take a balanced decision. So in that sense, I'm saying that it's better, you shouldn't think of buying a dividend yield stock for dividend. That's not akin to buying a dividend yield fund. I'm presuming the fund will do better than that if it is done on a blind basis.
Okay, fair enough. Rohit, back to you. Can you explain what will be the objective of the fund? How are you looking at stock selection?
Sure. So like we mentioned, there's both aspects there in the fund, which is capital appreciation apart from the income generation by way of distributions, right? So the way we will really look at stocks is that broadly speaking, you want to look at selecting stocks in two categories. One is which is called a naive dividend approach, where you just look at companies with high yields. But what's very important here is to look at whether they are sustainable or not. So for any business which is facing disruption, either due to, let's say, the energy transition, or there are potential corporate governance issues, or any other problems which might impact the dividend, that's something you want to be very careful about. And the second bucket of companies is where you will have a decent yield. So these are not companies which will have, let's say, probably 4, 5, 6% dividend yields like the first category, but these could have more moderate yields where you see them growing as well. So you see them growing the dividend as apart from having a decent dividend yield as well. So that brings us quite nicely into the fundamental analysis that we think we do so well, both on the first category where it's about figuring out whether the dividend is sustainable, and in the second category where you need to figure out how much the dividend can grow over the medium term. I think combination of that can give you the right kind of current yield for the portfolio, as well as pretty nice capital appreciation over time as well.
So one thing we established is that there is value to going about this from the fund route. But there are already, DP sir, quite a few dividend yield funds that are there in the market. So how is this fund expected to stand out?
See, as Vasan said, what we are going to do, anybody can do. But our way of looking at the things is little different. We are looking at the funds with a different lens, so as to provide a regular cash flow to the investor. That is number one. And number two, this era has come now. We are getting, because earlier there was no story, there is no specific benefit for the investors. Now in the new tax regime, the new tax regime, I mean to say not from the budget point of view, but otherwise, the new tax regime where the dividends are taxable, this fund is much more beneficial to the investor than ever before. Earlier we were not finding it too attractive for the people. Now there is a solution which we can knit around this. See, as you are aware, we always look for the investor ease and investor centricity, for the ease and for the how we can knit a solution around it. And we feel this is a very, very good solution which we are knitting around this through the dividend yield fund. That is very important. That's why this fund now. And second, of course, as I told you earlier, we are completing our bouquet. And see what Rohit has told me, this income fund, equity income funds are quite popular across the globe. I mean, as high as $50 million funds are there in the US. If that being the case, why it cannot be $1 or $2 billion in India also? And we have the capability and capacity to do this through our distribution network, through our investment expertise. I am very sure we should be able to do a very, very good number of mobilization in this particular fund, and we are very confident now. It's taking care of the volatility as well, because volatility is high. and see when low volatile fund with the income generation solution knit into the fund itself. So that makes it much better for this fund.
And that's the future, isn't it? That not just a fund, but offer a solution entirely. Vasan, you spoke about how there's some sort of downside protection in, dividend yielding companies. Can you explain what you mean by that? I mean, is it that they are risk free? Is it that they, work through downturns better?
Nothing is risk free, but if you assume that dividend yield is a subset of value, to the extent that value typically tends to outperform falling markets, that is where the downside protection is in a way. So if you have a large part of your earnings coming from dividends and you think that this is a growing company, then because the valuation is also attractive, it kind of is a better way to think about risk return from a upside downside perspective rather than just thinking about risk return relative to a benchmark, for example.
Okay. Rohit, one more question, which is that, there are a lot of myths that are associated, right? One is that, probably these high dividend paying companies would be mostly large caps, or that, public sector companies tend to pay larger dividends. So therefore, there may not be enough diversification in the fund. Is there any sort of basis to any of these myths? And, what is the kind of approach you will take in terms of what are the parameters you have defined for this stock selection?
Sure. So to be honest, we kind of went into this thought process with also having those myths in our mind, and we were happy to bust quite a few of them, and some of them may not be complete myths. Maybe we can talk about them as we go forward. But in terms of it not having enough of a universe, whether it's going to be just few sectors which commonly one thinks of as dividend yield, like you said, maybe the utility companies, oil and gas, maybe PSUs, we're finding that that's not necessarily the case. So whether you look at it even globally or with the Nifty Dividend Index, for example, it's quite nicely diversified with it being wide in terms of sectors. Like there's there's consumer stocks, there's IT stocks, there's autos, there's of course utilities as you would expect, financial. So what we are finding is that the universe is actually large enough to really construct a diversified portfolio. So that's not a huge concern. The other one was whether these companies would have any growth at all, or whether they're just paying out all their money as dividends because they have no growth capex opportunities. We found that there could be some companies like that, but those are the ones you either have to limit in terms of risk management for the portfolio to not cause capital destruction over time, or you have to then look for companies where you're growing dividends. And happy to note, we found many in the second category, which is the decent yield plus growing dividend category, where we found quite a few which could give you a say high single digit percentage growth rate, or even a double digit percentage growth rate, which so growth and having a universe is not a significant amount of problem. Diversification is available. The other two popular conceptions about this were that it's going to be large cap biased, and there is going to be it's just a value fund in another name, right? So to some extent those are slightly true, I would say, because on average, of course, averages hide all the fun facts. So even within, say, the mid cap and small cap buckets, we were able to look at quite a few opportunities where there are decent yields, or there are companies with slightly lower yield but growing their dividends faster, which one could potentially make use of. And finally, the value investing argument. So there you could have there would be a significant overlap, to be honest, because high dividend paying yielding companies would have lower PE ratios, generally speaking. But there's also, I think it's slightly different, because there would be some value stocks which are, say, deriving most of their value from a single asset, let's say, or maybe like a land bank or something like that, where the value stock is available at a significant discount to that intrinsic value, but is not able to pay regular dividends. So that's something maybe which this kind of fund would not look to do, but a value or a contra type fund would maybe look to do those aspects.
But historically, how have these stocks done on, say, the parameter of returns?
What Rohit is saying, see, basically we being the largest fund house in the equity side, and having more, if fund size becomes large enough, So, I think investment team has the capability to influence the dividend payment by the corporates also, and we will be able to do that. And see, I have seen so many cases when the companies come to the investment teams for the IPO with their IPO proposals and all, our team is definitely talking about it. What is your dividend paying strategy? How much you are doing that? So, as Rohit is saying, we will be able to influence the behavior of the corporates also if size is big enough. Today, in the whole category there is hardly 7 or 8,000 crore which is there. If the category, as you saying, globally is very big and this category becomes bigger, then category will definitely be taking a lead in influencing the corporates to pay more through their cash flows to the investors, because the money naturally flows to the investors only, rather than putting into the land banks and other things. It should be paid to the investors, and we intend to do that. We intend to have a change in the behavior of corporates through our fund. This, if we wish that it becomes too big to be able to influence that behavior.
That's good, touche to that. So, Rohit, wanted to ask you about returns as well. Historically, what is the kind of performance or outperformance that these companies could have done vis-a-vis the broader market?
So what we realize is when we look at the risk profile is certainly lower in terms of volatility as well as downside deviation. So that's nice from a less risky perspective. We were surprised actually that the returns of the Nifty Dividend Index was higher than that of the Nifty 500 index since the time that that index came about in 2007. So that was something we didn't expect going in there. We also then decided to compare the returns of, say, the existing dividend yield category versus a broader category like flexi cap, for instance. We were pleasantly surprised the return is fairly similar in those active funds versus active like flexi cap funds over pretty long periods of time. Of course, there could be some years in which dividend as a factor works less or works more, that not taking away from that kind of year-to-year volatility, but we found over a period of time this as a diversified portfolio of stocks with better risk profile and decent upside potential was also pretty decent.
Okay, so there is superior downside protection with decent returns as well. Vasan, one thing about this fund is that like a lot of the funds in the SBI bucket, this too is market cap agnostic. In terms of sector, it is agnostic. There is some sort of value bias as well. So can you explain this bottom-up approach that would be used for stock picking, which also we see in many of the other funds?
So this will be similar. We will look for stocks. Obviously, we look for stocks which have characteristics of higher dividend yields, and the parameters that go into our bottom-up stock selection process, whether it is like a short-term parameter or it's a long-term parameter, we use those same things. So for example, from a longer-term perspective, we typically look to buy a good business run by good guys at reasonable valuations. The valuation part will obviously, I think, partly will be taken care of by the dividend yield aspect. And on a shorter term basis, we typically look for incremental fundamental change, rising expectations, relative valuations, momentum, and we will continue to look at these factors and select stocks. It will be different to the extent that this will be largely dividend yielding stocks.
So that is the universe within which you are going to use the framework. DP sir, one final question to you. We spoke about more efficient taxation, but it's not just all about investing, right? At the end of the day, people want to have their money back as well in the most efficient manner. So there is this concept that a lot of people would have chosen the distribution scheme, right? Instead of, if you're not investing in direct stocks and getting dividends directly, they would look at using a mutual fund and the distribution scheme to get the money back. But is the systematic withdrawal plan, would it be a more efficient option for all investors?
Definitely. I mean, see, anybody who is used to getting dividends, if he puts in a growth plan and stops getting the dividends, so psychologically he will feel little jittery. So it's better to go for SWP option, and SWP is definitely a very, very tax efficient option, because your value keeps on increasing. When you take the money back, the major portion of that money comes as a acquisition cost of the units. So it's hardly anything which is to be taxed. And second, there is no TDS or anything. You have to declare your own capital gain or say whatever. And we, by the way, we did the back testing for the last 5 years. We said if in addition to the dividend, the yield is around 2.5% kind of thing. Even if we are taking 6% every year from these stocks, we did the back testing on the Nifty index, because we don't know what will be the portfolio. So there it is showing after taking 6% also for 5 years, is a very decent double digit gain on the portfolio. So you are taking the capital out, you are taking the dividends out, still your gain overall on the index is decent double digit return. So that gives us more confidence that taking the money back for 5%, 6% or whatever you need, you can take more, you can take less, that's as per the need of the person, but that if it's my money, I will definitely opt for SWP. I may use it, may not use it, may put it
because
back.
He's an old man.
Because I'm an old man and he's getting older. So that's.
We're all getting old. I think we can all do with an SWP.
Yeah. SWP is one of the beautiful tools which everybody must use in any case, whether it is a dividend yield fund or otherwise. That's something very good.
So thank you very much to all of you for talking about this fund, and don't forget that the NFO of the SBI Dividend Yield Fund is open between the 20th of February and the 6th of March. So do contact your advisor or mutual fund distributor to invest in this scheme. You can start with a monthly SIP of 500 rupees or a minimum lump sum application of 5,000. Thank you very much for watching, and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.